The debt ratio formula is to take total liabilities found on the balance sheet and divide that by total assets also found on the balance sheet. Let's look at two companies' worth of data. On the far left, let's do our first company in green. I'm going to call this low-risk company. Hope I didn't give away any answers. On the balance sheet of low-risk company, we find that low-risk company has $25,000 of total liabilities. Also on the balance sheet, we see that they have $100,000 of total assets. To calculate the debt ratio for low-risk company, we take $25,000 divided by $100,000 and we get 0.25 or 25%. This ratio indicates that for every $1 of an asset the company has, they have 25 cents worth of liabilities. Now let's move on to the next set of data in the middle, or in the orange. This company has $75,000 worth of total liabilities and $100,000 worth of total assets. Both of those numbers were found on the balance sheet. We calculate the debt ratio and receive 0.75 or 75%. Again, this company has 75 cents worth of total liabilities for every $1 of an asset. For the debt ratio, we know that the lower result is the preferred result. So in this case, the green numbers for low-risk company on the far left, the 25% debt ratio, is a better result than the 75% ratio for the orange company in the middle. The debt ratio is a long-term risk or a solvency measurement. So now we would say we are going to conclude on the numbers we have found. We would say that low-risk company is the least risky or the most solvent because they have the lowest debt ratio, whereas high-risk company is the most risky or the least solvent because they have a 75% debt ratio. Now let's add one more piece of company data over here on the far right in pink, and we're going to try to determine what their risk is as compared to low-risk and high-risk company. I will call this company Risk Company. On the balance sheet, we find that they have $250,000 worth of total liabilities and $1 million worth of total assets. We calculated a 25% debt ratio for Risk Company. Some students might make the mistake of assuming that because Risk Company has the most dollars worth of total liabilities that they are the most risky. However, using ratio analysis, which takes the size of the company out of play, we find that Risk Company is a bigger company. However, they have the same risk as low-risk company. So we would answer that both Risk Company and low-risk company are the least risky or the most solvent, and that high-risk company is the most risky or the least solvent.